All right, welcome everybody to Live Valuation. I'm Minus Moriarty, and today we're going to be taking a look at ticker MU, Micron Technologies. Company we've definitely covered before on the channel, at least once before. And it's pretty popular amongst retail investors in general, so I don't think it necessarily needs a huge amount of introduction, but regardless, it is a semiconductor company in the memory and storage space, pretty heavily involved in the markets of DRAM and NAND technologies. So very excited to kind of get into that. Before we do, taking a look at our watch list here today. It's definitely been some interesting movements in the market in the last week or so. They're one of our larger holdings, Facebook. There's been a whole lot of activity and downward movements in it. So it's been pretty interesting to see that. I've definitely been making larger amounts of purchases in it and adding to the position in general. I've also been buying a little bit more Smith & Wesson as I've been buying lately, and also been buying a little bit more Corsair. It's been some time since we were buying a little bit of that, but buying a little bit more of that as well. So definitely out there buying a little bit more in the markets. I'm definitely very cashed up, so I'm really looking to kind of start plowing a lot more money into the markets over the next month or two. So it'll be good to see the results of that. Here, just give me 1 second. I need to kind of double check a setting. It looks like maybe there's a little fuzziness going on. I don't know if maybe it's just my perception of it, but I wanted to make sure the stream is going well before we keep going. It said my connection was being a little bit funny, but either way, it seems to say that it's better now. Hopefully, maybe there was never any problem, like I said. But anyway. So continuing on, there's also lots of economic news to kind of behold this week. The Federal Open Market Committee meeting began today. So tomorrow we're expecting an announcement over the interest rate, which the market is expecting a 75 basis point interest rate increase of the federal funds discount rate. And then there's also going to be obviously the conference from Chairman Powell after that to discuss his outlook on the economy and basically they give their forward guidance over future rate hikes or possibly a slowdown of rate hikes, which is very much what the market seems to be expecting now, which is that a lot of the headlines have been saying that we're likely to get 75 basis points, but we're also likely to get some sort of telegraph that they're going to start slowing down in that regard. I'm not necessarily convinced that that's going to happen. We very well might get more telegraphing that they're going to continue to be aggressive instead. So we'll see what happens. Whether or not the market gets what they want, maybe they reacts positively, or maybe the market doesn't get what it wants and reacts negatively, or maybe it reacts positively or negatively contrary to whatever it supposedly wants regardless. But either way, it'll be interesting to see what happens there. But kind of going along with that, there also was some release of economic data here today. In particular, we had the JOLTS job report, which reported a significant increase of the actual amount of job openings compared to the previous amount, and also pretty significant increase over the consensus amount. We were expecting about 10 million in job openings. We got 7.7 million. So that's a little bit of something to kind of indicate more towards the side of the Fed continuing to be aggressive, not necessarily leaning towards the more softening side. And then also kind of in line with that, the quits were also down from the previous, but we don't have an expectation for that necessarily. So point is with the kind of economic data, there's not necessarily much to say that the Fed will slow down, but that seems to be the general opinion of the market currently. So kind of in the backdrop, I've also been working on some kind of like extra spreadsheets to do a variety of extra things for various tools for different purposes. One of the tools I've been working on is kind of trying to build a statistical model for trying to project inflation, both on a short-term 1 month basis and also kind of a long-term, like making an estimate of what I think of a long-term 10-year compounded inflation rate it could be. So I've been doing a lot of economic data analysis against inflation data, and in particular I did come up with a model for trying to model the short-term movements in inflation, particularly on a month-to-month basis, predicting basically what the next CPI report will give at the end of each month, which we just ended the month, and we're expecting to get the next CPI report in about 2 weeks. So this is basically the point where you lay in the projection and see whether or not you're right. So kind of I'm here today to make my first prediction, to kind of lay the groundwork and see how good my model ends up being. Just so that anybody's curious, the elements that I put into this model, the data that is particularly the statistics of which it is built upon, is gas prices, consumer expectations of inflation, the federal funds rate as it is in the open market, the rental increase prices according to Zillow, and commodity index prices. So a little of a mixed statistical model. Each of those are weighted accordingly to their statistical measures. And regardless of that, my prediction for the CPI report that comes out in 2 weeks is 32 basis points for the month-over-month increase. That is my prediction. And that should equate to approximately a trailing year-over-year CPI number for that month of 7.64%. And if you annualize the 32 basis points, it ends up as 3.94%. So that maybe gives you an idea of where it might be moving downward towards if we were to get this number consistently for a full year. But like I said, this would be the trailing number. This would be the month-over-month number. So I did copy paste that over here so that I can keep track of my predictions, and then I'll type in the actual here and we'll take a record of the difference. And I'm going to do this each month to kind of see how good this model is. And I'll probably end up tweaking the model as you know, I don't expect it to be perfect or anything like that. I don't even expect it to necessarily be that good, but I'm kind of curious to see just how good of a model I can maybe build for predicting inflation. And then, like I said, I also am trying to build a model for a longer term inflation, but I'm not necessarily going to talk about the specifics of that too much because, well, I can't really give you guys a prediction and then check it within a couple weeks and therefore give any sort of useful information on that regard like I can with a month over month. So anyway, that's one particular spreadsheet tool that I've been working on in the background as I was talking about. Other things I've been working on, I have shown this industry data tool set that I created over the last month or two, which is basically a tool for taking a whole bunch of data related to a data set of industries that I have of 94 different industries and a whole bunch of different fundamental data as well as market data related to those companies, and then building a spreadsheet able to look these information up, which we will use in today's evaluation. For example, I do have the semiconductor and semiconductor equipment industries up here for a reason, which is that's what the company that we're going to be looking at today. But the point is, when I finished this spreadsheet, I did say that I was working on a second version of it of global data based off of a global data set, because I do have basically access to similar data sets as per Aswath the Motoron. As I've said, I get all these data sets from him, but the same industries according to a US data set. The US data set has about 7,200 companies in it versus the global data set. If you look at that, that ends up having, what is it? I think it was like 47,600 companies in this particular data set. So looking at it from a global perspective gives you a much larger sample set. Not to mention, if your company is in fact a global company, then it's more relevant to maybe look at that than the US, because the US can have some specific details. So it gives the ability to look at the same thing from two different perspectives. And then, as I kind of already mentioned, we will indeed be looking at the semiconductor and semiconductor equipment industries in our evaluation today. So I do have those up here right now. And so also I will be working on, beyond that, I'm going to be working on a country data version of basically the same thing, because Aswath the Motoron also provides a whole bunch of data on the country level. Not nearly as much information, because you don't really need as much information necessarily for that, but like equity risk premiums, market caps, sales, certain multiples, as well as debt to equity ratios, tax rates, and things like that. So there is going to be a few useful things to get on a country level, and I'm going to be building a spreadsheet for a lookup tool related to that, but that one I've only just barely begun. So anyway, interesting tools that I've kind of been working on in the background. Like I said, one or two of them I'm going to be using today. So one of them that I completed was relevant to discuss today. The inflation projection tool, I kind of wanted to show that because that's just a little backwards side project I'm working in the background for a variety of reasons. And then, well, like I said, the country one is one that's going to be useful in the future, but it's only just begun for that one. So anyway, with that, we will get into the actual evaluation. We'll get started taking a look at Micron. Anyway, so like I said at the start, Micron is a semiconductor company in the memory and storage space. They were founded in 1978. They do trade on the NASDAQ exchange here in the United States, and their main currency is obviously the United States dollar, being on an American exchange. I do have all their major websites as well as the SEC website listed there. Their current CEO is Sanjay Mehrotra. I'm probably butchering the pronunciation of his last name. I heard on the call a couple of times, but either way, I have difficulty kind of getting it off. Mehrotra, something like that. He was elected and appointed to a CEO in 2017 after basically being acquired from a previous company. Top customers, it's a little bit more broad to kind of think about the top customers for Micron. They do have their customer base pretty broad and wide, basically anybody in the kind of general computing electronics industries, as well as AI and cloud computing having a huge impact there, but it goes beyond that basically to in a larger sets of applications of electronics, including automotive and mobile applications. So the customer base, you can think about them as pretty broad, but I included just really some major electronics players right here. Like I said, you can make a gigantic list of potential customers for them. Same kind of goes for competitors, but the major competitors to think about for them is Intel, Western Digital, and Samsung, although Intel is kind of becoming less of a competitor of them over the last couple of years. But either way, you can kind of think about that in terms of like how they've been competing recently. And then suppliers, I didn't name actually specific suppliers, but I did kind of want to bring up their Taiwan concentration of their business, which I do think has a significant impact on people, the way people perceive the risks surrounding them, whether those risks become realized or not. Obviously referring to the kind of political concerns of the Taiwan Straits and the Chinese government and US-Chinese relations and things like that. They are expected to report at relatively near the end of December. With this valuation is based off of the fact that they just did release their 10K from their earnings that was at the end of the month, about a month and a half ago. So this will be their first quarter coming in, which, you know, I'm pretty excited actually to be doing companies that are finally reporting their 10Ks here at the kind of early 10K releasers, the ones that get their 10Ks in before the end of the year. Whereas, you know, the majority of companies get them in kind of like mid-February or something like that. So I'm excited that we're kind of getting to that part of the year where we can get to companies like MU that are reporting 10Ks at this time of the year, and I can kind of focus specifically on 10Ks rather than 10Qs. A little bit of a personal bias for me personally, but whatever. So anyway, their revenue guidance, they really only provided some specific guidance for the Q1. They didn't give fiscal guidance, but they did provide a pretty large array of specific information and guidance, which we're actually going to look at in their presentation as well. But I did kind of want to bring these things up at least here. 4.25 billion expected for Q1, with 15% long-term growth expectation for the DRAM section of their business and a 28% long-term expectation for the NAND. I should say 15%. They said it was more like mid-teens is what they said, so I'm kind of throwing a 15% on there, whereas they kind of specifically throw 28% on the NAND expectations. I think they're getting that from consumer investment research reports and things like that. Other guidance expectations of about 4 cents for the Q1 EPS, so there is expected to be a pretty significant drop in EPS in the Q1, with a general drop in profitability going around. Also, in line with that, they're expected to get 26% gross margin, which is a very, very significant decline in gross margins across their kind of like longer term annual gross margins. But again, this is Q1 information, so obviously there could just be some large cyclicality in this particular year compared to normal years, and they usually have some pretty high cyclicality to begin with. So they're expecting to have huge amounts of investments weighted towards the first half of the year relative to the second half of the year. Analyst expectations for the full year, 18.9, about 19 billion or so for the year, according to 30 analysts, and then 27 billion for the year after that, according to 25 analysts. And then earnings for the full year, according to the analysts, is 53 cents. And so you kind of just like do the logic there. It's like if you just assume that the analysts and the company are kind of relatively in line with each other, which they might not actually be in line with each other, but you can think about it that way. 19 billion, you just take a quarter of that, and you end up with 9.5 billion divided in half, so that's 4.75 billion. So 4.75 billion, and then they're guiding 4.25 billion. So you can see that how there's already some cyclicality baked into these numbers, just assuming that this Q1 assumption from the company and the 19 billion year estimate from the analysts is even somewhat in line with each other. There's some cyclicality built into there. And the same thing goes for the EPS. A quarter of 53 cents is going to be what? 13-14 cents. So 13-14 cents compared to 4 cents guided for the first quarter. There's going to be a huge cyclicality in the EPS as well, presumably, like I said, assuming that the analysts and the guidance are actually in line. Very, very often they're not. So that is a big assumption to kind of throw in there. But regardless, you can kind of see the logic of it. And then for the next year, because I was just talking about the year, this next fiscal year, the year after that is expected to have a large bounce back up to $3.68 per share, according to 25 analysts. The trailing 12-month last dividend, 43 cents per share. That is analyzed off of the yield of the kind of relatively recently started dividend. And they also upped the amount of it most recently. So the next quarter, which I'm pretty sure the ex-dividend date is actually about to pass, if I'm not mistaken. But it comes up to actually now 46 cents per share if you analyze the current dividend yield, which ends up being a little under 1% on the current share price. They also have about $3.5 billion of authorized share back amount, which equates to about 5.8 of the current market cap, and they've been doing pretty aggressive amounts of share buybacks. So you know, when you have an authorization in place, that doesn't necessarily tell you that they're going to use it all in 1 year, so you can't think of this as like a yearly amount. But I mean, I don't know, I mean, they might really burn through it within a year or two or something like that, because it kind of goes in line with their capital allocation plan, which we'll get into in the presentation. But basically they're committed to returning 100% of free cash flow over the cycle, is the caveat they throw in there. So obviously in any given year they may not throw any cash flow out, but over the cycle they expect to throw a cumulative total amount of their free cash flow out. Percent held by insiders, 0.34%, so not very much held by insiders currently, a very tiny fraction. However, in the last 6 months it has increased by 60%, so somebody's been buying. That's usually a pretty good sign. Somebody seems to think that the drop in share price is pretty sufficient, which we'll get into my projections for the company. And I mean, you know, I think that doesn't sound like them necessarily making a terrible idea. Percent held by institutions, 83% or so. Current short amount, 2.77%, comparative to the short float. No real difference there, about 2.78%, partially because there isn't really a huge difference between the float and the overall share count. Short ratio 1.33 days, so no real extended amount of time for shorts to get covered, so no problem for them there. 3-month average volume 18 million shares versus the last 10 days have been 19 million shares, so there has been a little bit of some acceleration in the overall buying volumes of the company, which, I mean, it could be partially just in line with the generally a little bit more bullish attitude that the market's been in the last week or two. So it could just be kind of the general market, but either way, the point is there's some buying pressure backing up behind it. So anyway, like I said, we will get into some details of the presentation, as well as reading a little bit from the management letter, which actually I'm going to read that part first before we get into the numbers. Kind of want to just talk some of the details they talk about the market outlook, which I thought was pretty relevant to kind of thinking about the next year or two that they're going to be going through, and then kind of the long-term perspective, because like this industry's very cyclical, and so kind of understanding the fact that they're going to go through some very low downward bouts in profitability and then bounce back pretty sharply is important to understanding the trend and how we're going to build that into our numbers. And I mean, like I said, I've covered this company before. I've covered other companies in the same space, like Qualcomm, for example, which has a very similar type of cyclicality. It's not the same type of semiconductors; they're in a very different segment, but it has a very similar type of cyclicality to it, where it's going to be kind of like up and down, both in profitability and in the overall revenue growth rates. But anyway, I kind of detract. So anyway, just going to read it off. As I said, the memory and storage industry environment has deteriorated sharply since the last earnings call. Calendar 2022 industry demand growth for DRAM now expected to be in the low mid single digit percentage range, and for NAND slightly under 10%. Now that's the industry growth he's saying, not the company growth. An unprecedented confluence of events has affected overall demand, including COVID-related lockdowns in China, the Ukraine war, and the inflationary environment impacting consumer spending, macroeconomic environments influenced by consumer buying behavior, yada yada. These factors depressing demand for DRAM and NAND to well below end market consumption levels. Basically saying, so it's like, yes, the overall industry demand is going to be growing, but the consumer demand is going to be growing at a slower pace than that because of all of those macroeconomic factors. Due to the sharp decline in near-term demand, we expect supply growth to be significantly above demand growth in calendar 2022, contributing to very high supplier inventories for both DRAM and NAND. So they're giving it right off the bat. They're giving that warning pretty much right from the get-go. Hey, we're going to be increasing our inventories. Our profitability is going to be coming down. Overall supplies are going to be going up relative to demand. So that's something that has to be seriously taken into consideration. They're giving you that warning now. Looking ahead in calendar 2023, while macroeconomic uncertainty is high and visibility is low, we currently expect demand growth to be closer to the long-term growth rates of both DRAM and NAND, bouncing back from weak levels in calendar 22. We expect the inventory at our customers to improve in the early calendar 2023, causing demand to both rebound starting from the second quarter of the calendar 2023. We expect calendar 2023 industry DRAM supply to grow well below demand growth. We are modeling a middle single-digit percentage growth in both DRAM's industry supply in 2023, which would represent the lowest ever industry supply growth. NAND supply growth in calendar 2023 is also expected to fall well below demand growth. So they're as I said, they are already kind of saying that they already expect their industry supplies to be coming out relative to the fact that their industry is still going to be growing, but the fact that everybody in the industry has already made large purchases, so that their supplies are going to have to come up relative to that. But they expect the demand for the consumer end products to start to bounce back in the early calendar of 2023, which means in mid 2023 they're going to get their demand starting to bounce back. So they're saying we're going to have a bad first half of 2023, but and then the second half of 2023 we expected to bounce back, which admittedly that's the same story that pretty much all companies are giving right now. So you do kind of have to take that with a grain of salt. That's just kind of the general story. But that is like I said, it makes sense given the overall story that he's painting, that their products are at a certain stage in the development relative to the consumers. The consumers are many stages past them, many purchases past them. So that's going to be relevant for them going into that. So anyway, we'll get into the actual segmentation and the discount rate and getting into the numbers of the company. Before I do get into that, I will say if you're watching either now live or on replay, please give us a like. Giving us likes helps attract more viewers to the channel. More viewers to the channel gives me more incentive to make more content like this. Also, if you are already liked it, it'd be really great if you could subscribe to the channel. If you're not already, subscribing to the channel will give you a notification when I go live, as well as whenever I release other content. For example, the video that I did on the Q3 returns of both the market as well as my own returns. So you can go check out that video if you're interested in that. So anyway, getting into the actual valuation for the company, like I said, we'll start with the segmentation. As I said, looking at our data sets, we are putting it in the semiconductor industry, which means I'm applying an unlevered beta for its industry with my own methodology of 1.09. And then the average sales to capital ratio for the industry is 0.75. And then the average net adjusted margin, which is adjusted for R&D capitalization, of 19.5%. I'm doing that based off of the industry data set that I have here, as I was talking about. The adjusted unlevered beta is currently 1.09. For the adjusted net margins, I typically like to look at a longer term average. So I have an 8-year spread, which is the longest spread of time that I have, 19.5%, which, like I said, you can look at the semiconductor industry, equipment industry, which has lower margins relative to that. And then also the sales capital ratio. I like to look at an average, but not quite as long of a term average when it comes to the sales capital ratio, because I do think that the current investment levels of the industry is pretty relevant to look at relative to current profitability levels. Profitability, I like to look at a longer term average. For investment, I like to look at something a little bit more recent to get an idea of like the change in the industry. So a 3-year average is what I use for the sales capital ratio, and the 3-year average is 0.75, which what that means is that each company in the industry on average earns 75 cents in sales for each dollar of capital invested in the business. And then as a result of the dollar of the 75 cents of the sales they get, they end up keeping 19.5% of that as profit. So anyway, moving on from that, like I said, that's an explanation of kind of the segmentation. The unlevered beta of 1.09, I then lever up according to its overall leverage of 7.7 billion dollars in total debt, including lease liabilities, which are at a weighted average maturity of about 10 years and a weighted average interest rate of 3.79%, which is a pretty good overall maturity. 10 years, pretty good amount of time to work with, and that's a pretty low interest rate to have for it. So pretty good debt profile, I will say, for the company. And that gives them a debt to equity ratio of about 12 to 13% at market value weights. And then that takes the 1.09 unlevered beta and turns it into a 1.22 levered beta. That's the beta I use actually for the company itself, which, by the way, we can compare that to the market beta of 1.29. So I'm actually giving them a slightly lower beta than the market does, according to Google. And then that gets me to a cost of equity of 10.9%. The equity risk premium that I use to get to the 10.9% is based off of geographic disbursement of both their revenues and their production assets, which in the United States, they have about 52% of their revenues. And in Taiwan, they have 20% of the revenues, 10% in mainland China, 5% Japan, 5% Hong Kong, 3 to 4% in Asia Pacific, and then 2 in other. Versus the production, you can see they have 33 to 34% in Taiwan, and then 30 to 31% in Singapore. The reason why I kind of point this out is you can see that there's a little bit of a discrepancy overall, with a huge section of the production coming from specifically Taiwan and Singapore, comparative to the huge amount of the revenues coming from the United States. And I bring this up because there is actually large plans in place for them to adjust their overall production levels, what with their plans to change out a significant portion of their the base where they're going to be doing large amounts of their capex. I did kind of skip past the presentation. I meant to go straight into this afterwards, but they have this plan right here. Earlier this month, we announced that we've chosen Boise as one of our 2 leading edge DRAM manufacturing fab sites that we're planning to build in the US. We expect to invest approximately $15 billion in that site through the end of the decade. So that is a little bit of the caveat there. That's about a 10-year period. We're talking about a 5-year period right here. But so I don't know, maybe 15 billion. We'll say maybe they do half of that within the 5-year period. Boise is where their headquarters is, so they already have some facilities there. It's worth noting. But if we if we come back over to this over here and take a look at the productions, we could, for example, take the United States number and then just kind of throw about half of the 15 billion onto there. And then we would have to throw that amount onto the total as well to make the percentages reflective of that. And you can see that that actually would change the overall weights of the United States amount of the assets to 23%. And then that would change Taiwan to 24%. So that at least would put Taiwan on par with the United States. Again, that's at the end of a 5-year period, assuming they did half of the 15 billion during that time frame. You could also argue that they would do all 15 billion perhaps up front, and it just takes 10 years for it to all get there. So that's maybe another way to look at it. If you did take it from that perspective, then that would actually take the United States' production levels up to 30% versus Taiwan down to 18 to 19%. So the large concentration of Taiwanese production that I was talking about earlier, they are kind of making some moves to alleviate that and bring more production back to the United States. What effect that's going to have on further profitability for the company in the future is another thing to say, because that brings a whole lot of other factors into question. For example, the wage levels of workers in the United States, not to mention benefit levels, as well as the fact that they wouldn't have to do necessarily as much shipping costs for certain things from the United States to Taiwan and then back to the United States. If it's all in the United States, then they might be able to save money. So it might cost them more money in certain ways. It might save them money in other ways, and that might be hard to determine the overall balance of it, but it does take away from perhaps some of the risk concerns that people had related to the company. So anyway, that little bit of a diversion for that little detail about their production facilities, but I did want to cover that. Moving on, as I said, we have the cost of equity of 10.9%. We can start to take a look at the actual financial history of the company for the 10-year period that we have, which is between 2022 and 2013. I just realized I don't have this, the fiscal year marker up here actually changed. Let me change this real quick. There we go. Anyway, so they went from about 9 billion in 2013 up to 30.7 billion at the end of the most recent quarter of 30.7 billion in 2022. You can see that their gross margins have moved pretty dramatically through this time frame as well. Going from a 20% gross margin in 2013, though this may have been an outlier year as it did immediately jump to the 30s at this point, up to 45% in 2022. Like I said, it's very, very volatile. As you can look, there's another 20% in 2016. There's 30% after being down from 58% in 2018. So it's really just a very, very volatile gross margin. Looking at the average over the entire time frame, it's about a 36%. Comparing that, for example, against the gross margins that we were seeing in their industry in the United States, 55%. Or 56% for a longer term average. Taking a look at semiconductor equipment, it's 44%. Taking a look at maybe the same figures on a global scale, you see it comes down to maybe 44% or 38%. So maybe on a global scale, that kind of puts them a little bit more in line with it in gross margins. Again, that was a 5-year average though, so maybe we would have to actually look at the 5-year average for them. 5-year average for them, it comes out to be 44%. So that's actually pretty well in line with the global semiconductor industry. But again, you can see that that's relative to the upward movement they had in the first 5 years. So the first 5 years, it was about 30% versus, again, that like 44%. So that's partially the cyclicality that I was talking about, but also partially growth in their overall market share. Because I did take kind of an interesting little line right here where you can see these percentages. What I did is I wanted to take a look at their cyclicality, moving from basically low points in the revenue up through higher points and kind of seeing at what the growth rate is like from the low point of the cycle to the high point of the cycle, but then also from low points to low points. So you can see, for example, I have this 80% here, which is the growth from 2013 to 2014, which is representative of from a low to a high. It's only 1 year, but it's still the first one in that set, so I'm kind of including it. So from a low to a high, and then for here, you can see that this is actually from 2013 to 2016. So that's from a low to a low, because then it went down to 12.4 billion, which you can see is actually kind of the low point from the surrounding area. So from a low to a low over the 3-year compounded rate, it ends up being about 11%. And then if you take a look at the next movement of from that same low up to the next high, which ends up being a 2-year period, that compounded rate ends up being 57%. So you can see kind of the pattern I'm doing here. I'm kind of seeing what does it look like moving from bottom of the cycle to the top of the cycle, but also from bottom of the cycle to the next bottom of the cycle. What does that actually look like over time? And then, like I said, I did this over and over again, another low to low, another low to high, and then another low to low, counting my projections into this next year, because there is a general projection in the analysts, as well as their own projections, as well as my projections, that the company is going to have a downward movement in revenue in this next year. So I kind of just decided to count that so that I could have 3 and 3 for these numbers. I wanted to have equal amount there. And then I took kind of an average of these cycles. So the average upcycle growth rate ends up being 52%. That's, again, a yearly compounding. The upcycle on average moves upward of 52% compounded. The down cycle has compounded at 7%. Now, the interesting thing to note there is that it's positive even in the down cycle. So obviously that just shows that this company has been growing like a rock star. But you can see that the variability in the growth rates is extreme. From 52% compounded to 7% compounded. And then like I just took a 10% uncertainty kind of discount against it, just knocked 10% off of that, 47% to 6%, and then average between the two gets me 27%. And I was like, well, okay, based off of that, from the current down cycle that we're at, if we projected forward based off of this down cycle to down cycle, what would the next down cycle be? About 25.5 billion. Now that's kind of relevant to some of the future projections that we're going to make. So I'll get into that in a little bit later, but I am going to be using this information to try to predict for the future based off of assuming my worst case and best case scenarios will basically be like, well, are we going into the bottom of the cycle or are we going into the top of the cycle? So I'll use those numbers as kind of a guiding principle for my projections. But anyway, so I was a little bit of a diversion into kind of stuff related to my growth projections, not fully talking about just the financial history, but we did get into at least the gross margins. I'll move back past that. Coming down a little bit further, we can also see just one thing I do at least want to call out is that how consistently that their R&D has been moved up. You can see that there is a pretty large amount of variance in the growth rate of their R&D as well. But if we then boil that R&D growth rate down to a more of a compounding rate, it starts to smooth out much more consistently. So what that shows to me is that their R&D is much more consistent than their actual revenue growth. Wheezy23. So does this show that their cyclicality is smoothing out? I think I heard Monish said something along these lines. Not that I'm seeing, no. I'm not assuming that it's smoothing out necessarily. It would smooth out naturally to some degree, no matter what, just because of their scale. I haven't listened to Monish talk about them too recently, but I do know he's one of the bigger, more vocal investors related to them. I would say that they would naturally have a smoothing effect happen just because of their scale. Like I said, they went from 9 billion to 30 billion in a 10-year period. Based off of how much you're moving into the future, you're going to assume that they're also going to grow up pretty significantly in the next 5 years, and at that point, they're going to be a pretty big company. I'm not really necessarily assuming that the cyclicality slows down. I'm just using it as a guiding principle to try to decide how variable I think the growth rates will be in the future, which, like I said, we'll get into that when I get to the projections. Right now, we're still basically talking about their past. And going down into adjusted net margins, which is net margins that have been adjusted for an R&D capitalization, because I like to capitalize R&D, considering that R&D is a form of capital expenditure that is related to long-term profits, which means that even though I have 10 years here, we can really only focus on the first 5 to 6 years of the period, because it's the only period in which the numbers are fully capitalized. Beyond that, it only has a partial capitalization effect, so it's not going to be fully accurate with the other numbers. But regardless of that, you can take a look at the kind of the average for the last 6 years of their adjusted net margin. It ends up being about 30%, which is very, very significant. Huge profitability for the company. And that part also hasn't really necessarily been super variable. There is a 15% in 2020, but regardless of that, it's still pretty strong. Moving down a little bit further. Oh wow, I just realized I didn't actually pull this line across. Hold on a second. Let me double check this, make sure I didn't screw that. Okay, yeah. So anyway, coming down to the cash flow line, we can take a look at their, wow, I did the same thing here. Hold on just a second. Let me double check I didn't do that in another spot. Because apparently I was sleeping at the wheel when I was setting this up. Okay, yeah, no, those are the only two that I didn't do that for. Coming down to the cash flow line, we can take a look at their adjusted net capex, which adjusted net capex is a figure I like to use, combining both capital expenditures and depreciation and amortization, along with the R&D, along with the R&D capitalization amortization that I was talking about, as well as any acquisitions done by the company. So basically it takes all forms of future growth prospect cash flows that you're doing, any form of reinvestment of your profits for the growth of the company, and boils it all into one number. And but that's what we have right here. And we can see that that itself has also been growing pretty consistently over time, moving from, for the first few years, averaging about 2.1 billion. The next few years, it averaged about 5 billion. The next few years after that, it averaged about 4 billion. So it came down a little bit more. And then now it's been growing back up, averaging about 4.6 billion the last 3 years, but being 5.9, close to 6 billion in 2022. So based off of that, you can kind of see like where the actual growth has been put in place by the actual company itself, with the largest reinvestment of the company occurring approximately right here, 2017 to 2019 being the largest sections that we see. But that also comes in line with the $2.6 billion acquisition they would have right there. So that's definitely part of the reason that that's in there. For example, if we were to subtract out 2.6, that's a little bit less than 2.7, which is average about maybe 900 million per year. So for example, if we subtracted 900 million per year from 5.2 billion, which is the average for this 3-year period, then it would be more like, what was that, 4.3 billion over that time frame, at which point it would be much closer to it would be actually a little bit less than the average of the next 3 years that we have. So if you take out the acquisition, you would see that their actual the growth has been consistently smoothly moving up over the entire 10-year time frame, which, like I said, considering R&D is actually a really large component of the reinvestment for most tech companies, and it definitely is going to be the case for them. Yeah, you can see, for example, 3.1 billion in the most recent year, compared to, as we were saying, it's about 6 billion or so. That is the amount that they had in this most recent year. And then also over the 10-year time frame, it averaged about 2 billion for R&D, and then the average adjusted net capex that we actually had was about 4 billion. So yeah, literally over the 10-year time frame, about half of the reinvestment the company's done has been R&D, which is what you would expect to see. That's what you'd hope to see. If you didn't see that, well, I mean, that might be the problem. So yeah, that's what you would expect to see. Outside of the fact they had this acquisition, they've consistently been growing their reinvestment. So the fact that this looks like it's a little bit of a larger period, you can kind of ignore that. They're actually growing their reinvestment, which gives me more cause to believe that growth rate is going to continue in the future, regardless of the cyclicality. Like I said, there's going to be uncertainty of which part of the cycle. That's kind of what I mean. It's like, I expect their growth rates to be pretty extreme over like the next 10 to 15 years. It's going to be pretty strong growth for them, assuming they can keep that reinvestment and that R&D process growing. As long as they can keep the R&D growing, I would expect them to keep growing pretty significantly for a 10 to 15 year period. The question is wondering whether or not we're at the top of the cycle now, or if we're at the bottom of the cycle now. Because if you're at the top of the cycle, well, then, like I said, we could maybe expect 7% growth rates, because if you're at the top of the cycle, you have to go down before you can go back up. If you're at the bottom of the cycle already, well, then you expect the upper end of the range, and then you can maybe just zoom all the way up, and then maybe it's like 52%. So that's where the uncertainty comes in, is wondering, well, which part of the cycle are we in? Are we at the top of the cycle or the bottom of the cycle? So anyway, moving on from that into the returns on invested capital with their cash flow. You can see the returns on invested capital, which is on this line right here, very extreme over the entire time frame. For the first 5-year period, it averaged about 18%, but this is something that does suffer from the R&D capitalization, similar to the other spots we're talking about. So really, the last 6 years is really the time frame in which we can look at most accurately, that reflects the actual reinvestment of R&D in the book value numbers most accurately. But that comes out to be about 19% per year for that 6-year period. 5-year period, about 19% still. So 19% returns on invested capital, very strong. Coming down to the balance sheet, we can take a look at that. You can see that their cash levels have also been growing pretty significantly over the entire time frame. They average about 3.7 billion in total cash on hand for the first 5-year period, not counting their marketable securities, because they have had some marketable securities kind of sporadically depending on the year. But in the next 5 years, it averaged 7.4 billion. So definitely an increase in this kind of the general levels of cash being held on hand. And then currently they had 8.2 billion. So even so, that's more than the average of the last 5 years. And then, as I was saying, they also do have about 1 billion in marketable securities, short-term marketable securities. So lots of cash, lots of liquidity on hand, which gives them the ability to do all the reinvestment that they're going to need to do for that growth without necessarily having to go back to markets for either debt or equity. So that's really great. Accounts receivable, 5.1 billion. We can see that that's relative to for the first 5 years, they averaged 2.7 billion, and the next 5 years, it averaged 4.6 billion. So definitely a huge increase in the overall receivable levels. The real question is wondering how that compares to their payables. For the payables, they averaged for the first 5 years 1.5 billion. So it was they still have a pretty good ratio there, but a little bit closer of a ratio versus the next 5 years 2.2 billion. So now their overall ratio of payables to receivables is starting to come much better in line. As it currently is, they have more than twice as much receivables than payables. You wouldn't necessarily want to see the receivables go too much out of hand. Technically, it's bad to see both of those things get too large, in my opinion. You want to have more receivables than payables because that way you have the ability to pay your bills and have good liquidity for doing it. But if receivables grow too much out of hand, that might show that your customers have a better spot in the relationship. It means that they can kind of basically just say, I'll pay you later. You know, it's like you don't really want to see receivables go out of hand too much either. Again, not saying that that's what we have here. Their receivables are not really a problem. They're it's a ratio about 2 to 1. That's kind of about the sweet spot, honestly. Anyway, inventories, that's much more of probably a real concern, though also, again, not necessarily something that's actually a concern, just something that in general I would pay more attention to. Inventories for the first 5 years average about 2.7 billion. In the next 5 years, they average about 5 billion. So they have significantly increased the overall inventory levels that they have on hand. But that's what you would expect of their growth in assets in general. And for example, in general, their assets have actually grown at a much faster clip. The average assets they had was 25 billion versus the average assets they had for the next 5 years was 54 billion, which is a little bit more than a doubling versus more of a straight doubling in the inventory levels. So their assets are growing at a slightly faster pace than the inventory levels on this kind of 10-year average horizon. The inventories themselves in the most recent year ending at 6.6 to 6.7 billion, comparing that to the overall asset level of 66 billion. So that's about 1/10 of their assets that are in inventory levels. And for example, we can compare that to the 19.1 billion they had in 2013, and they had 2.6 billion in inventory. So that would be a little bit more than 10%. I'm not sure exactly what that ends up being, maybe like 13 to 14% or something like that. So technically, you know, if you're looking at it in terms of percentage of asset terms, their inventories have actually come down a little bit over the time frame. Though it is a pretty sharp increase in the most recent year. So that is something to still pay attention to. Like I said, they themselves gave warnings of that in the presentation in the letter that we were reading. So anyway, coming down, we already talked about kind of the growth of the general assets, but looking at the growth of their general liabilities, or really we can take a look at their current assets, like kind of skip past that line. The current assets started in 8.9 billion in the first 5-year period, averaging 9.9 billion for that first 5-year period, and then averaging 18.4 billion for the next 5 years, and then ending at 21.7 billion. 21.7 billion compared to the current liabilities of 7.5 billion. So very, very small amounts of current liabilities compared to the current assets. In fact, you can see 21.7 billion of total our current assets compared to the total liabilities of 16.3 billion. So they in fact have more current assets than total liabilities. That means that they could use the liquid assets they have. That's what current assets generally are thought of as the more liquid assets. They could literally pay off all their liabilities with that, and then all of the operating assets, the $82 billion in gross property that they have, 39 billion in net, and as well as the intangible assets they have, which is a relatively small amount, all considered. They do have really just a huge amount of actual physical property. That property, effectively speaking, it has no liabilities to it. It's basically just at the pure cost of the market cap, which is a good thing to see. So the point is, yeah, very, very small amounts of liabilities. This is a very, very clean balance sheet. It's very much what you like to see, seeing that tiny amount of liabilities. And we can compare it to 2013. 9.1 billion was the total liabilities they had then, and they had 8.9 billion in current assets at that point. So, you know, in 2013, they were already pretty close to that pretty excellent state. Let's see, 2014, 10.2 billion, 10.8 billion, 10.9 billion. When did they get to that point? 9.4. Where is it? At what point did they cross the line of having more current assets than total liabilities? It looks like 2018, which is when they made that acquisition, incidentally. Or 2017 is when they made the acquisition, but they would feel the effects of it in 2018. But yeah, so I mean, you know, for half of this time frame, they've had that clean of a balance sheet, and even before that, they would still have way, way more assets than liabilities. We were talking about the current assets. So coming down to the shareholders' equity, you can see what that means for the shareholders' equity. The fact that they've had such a good, clean balance sheet that has literally still improved. Like they had a great balance sheet in 2013, and they have an even better balance sheet in 2022. That's just amazing. So they've been extremely profitable, as we've talked about. So they went from They went from common shareholders equity of 9.1 billion in 2013 up to 49.9 billion in 2022. Now those numbers, they sound kind of remarkably familiar. I would kind of point out that, like, for example, we started at 9.9 billion or so in 2013 in total revenue. We have more shareholders equity than we have in revenue, even though the revenue was relatively close in 2013. What that kind of shows me is that their ability to actually save overall capital to accumulate profit has been growing at a much faster pace than even their revenue growth. You can see that in just the sheer number of the overall value of their shareholders equity. And then that doesn't take into account the overall retained earnings itself, which is an internal component that's going to benefit from further leverage within. They actually had negative shareholders equity in 2013, but then went to 2.7 billion in 2014, and then that's skyrocketed up to 47 billion in 2022. So now the vast majority of the shareholders equity is in fact retained earnings, and that's off of the back of still having done significant amounts of share buybacks over the last few years or so. And then, as I had already talked about in the presentation, they had said that they are in fact committed to returning the basically the entire amount of their what is it? Here it is. Yeah, they're committed to returning the total amount of their free cash flow over the entire cycle through share buybacks and dividends in one form or another. That's over the cycle, so it doesn't mean in any given year they might have a bad year where they're going to be taking all their free cash flow, or not a bad year, but a bad cash flow year where they're taking all their cash flow and they're reinvesting it instead, and then maybe a few years later they're going to have some crazy amounts of share buybacks, and that's kind of the way they plan to operate their business. So coming down to the sales capital ratio, which is the ratio for reinvestment profitability or capital efficiency that we like to use, as we've talked about. Their sales capital ratio for the first 5-year period averaged 0.72 or 0.73, which means about 73 cents in revenue for each dollar of capital invested in the business. For the next 5 years, they average about 0.8 or 0.58 or 0.59, which is 59 cents in revenue for each dollar of capital in the business, which means you can see that they've had a much lower amounts of revenue relative to the total capital for the last 5 years relative to the first 5 years. Now, you can think of that as them becoming less capital efficient, or you can think of that as them front running a huge amount of capital efficiency into future revenue growth. So two ways to look at it. Either they're making reinvestments that are never going to pay back, or those reinvestments are being made and then the revenues are going to come back later. Nukit looks promising. Yep, looking real promising. Thanks for joining the chat, Nukit. Kind of sliding over so we can start to take a look at it. Depends kind of what you mean by promising. I am weighting in a lot of negative expectations, but as what we were talking about in terms of just looking at their balance sheet, it's a fantastic balance sheet, that's for sure. And the qualitative aspects of the business in financial terms, like the like I said, capital efficiency, their returns on capital, the profitability, it's all very fantastic. It's just a question of getting it at the right price. It's like this is a fantastic business, no doubts about it. Well run, well managed, shareholder focused, clean balance sheet, all of the good stuff you want. Just a question of getting it at the right price. And then depending on which model perhaps of the various sets that I present might dictate what you think about that. So anyway, coming up to the revenues, kind of getting into what I was talking about with the cyclicality. So as I had I'll review what I had said before, I had kind of taken a measure of looking at the revenues, looking at from basically the low point to the next high point, seeing what it is from a low point to the high point of the cycle, but then also taking a look at any given low point to the next low point of the cycle. And I did this over and over again to kind of get an average of what it looks like from low point to high points in the cycle, as well as from low points to low points in the cycle. So for up cycle average, the average compounded yearly growth rate for the up cycle, which means from the down point to the up point of the cycle, the average compounded growth rate was 52% per year, which is insane. That is just insane growth. The average down part of the cycle, which means from the high point of the cycle effectively to a low point, it basically means the lowest point of the potentiality is 7% on a compounded growth rate, which that would be respectable revenue growth for a normal company. So that's just insane. That's pretty spectacular to think about. As I had kind of talked about, I decided to just kind of knock off 10% for each of these as just kind of like a way of throwing some uncertainty into my measurement here. And that got me to 47% and 6%. And I took the average of those two, that got me 27%. And then I kind of just applied the down part of the cycle to see what would the revenues look like from the most recent part of the down cycle to
that, and then that gave me 25.5 billion. So anyway, coming over here to the actual projections for the company, I put 10% in here and 45% here. What that's supposed to represent is basically this 6 and this 47%, but I decided to kind of round up a little bit for the 6%, and then I rounded down a little bit for this 47%. Obviously there's more rounding up than for rounding down in there, but whatever, just kind of throwing some numbers in there. 10 to 45%. 27% is right in the midpoint there. I kind of rounded up to 30% for the lean. That gets me an expected CAGR from this 30.7 billion that we currently have right here of 11.5% or so. In the short term, I'm having it come down to the 9-year average that has then also been cut by 30%. That gets me to an average expected revenue of 18.7 billion. The reason why I'm doing that is just because of the analyst projections for the company. The analysts are projecting 18.9 to 19 billion or so for the next year. And so I basically just simulated what I had to kind of throw that in there for the short term. And then, as I had kind of talked about, I was kind of using this first year as part of my average of the down part of the cycle, partially because I wanted to make sure I had 3 up cycles and 3 down cycles for my kind of math here. So a little bit of some weird statistical number play that I've done here to kind of come up with this, but this is how I came up with my projections for the company. That gets me to 23.4 billion for the worst case scenario, which is a little bit less than what that estimate that I came up with right here of 25.5 billion. And then in the best case scenario, I end up with 93.3 billion, which is more than tripling from where they're currently at. But I mean, you know, look at what the revenue has done at various points in here. You know, that's kind of what I'm looking at. It's like it almost tripled from 2016 to 2018, right there, right? You know, that's kind of what I'm talking about. It's like the cyclicality is pretty extreme in here. It's just quite a question of wondering where this 30.7 billion is. Is this the high point of the cycle, or is this the low point of the cycle? That makes a pretty big difference. And I really do believe in the stuff that they were talking about in their presentation, in the letter. They talk about the letter. I didn't show it in the presentation as much, but they're talking about their overall expectations for the industry, which we did talk about. What is it here? We are modeling a middle single-digit percentage growth in DRAM industry in 2023. NAND supply growth in CY 2023 is also expected to fall below demand growth. Expected long-term DRAM bit growth to be in the mid-teens percentage, slightly lower than our prior expectations of mid-teen highs due to moderation expected long-term PC unit trends. We continue NAND market which benefits from elasticity to grow around 28% over the long term. Now, so 28% and mid-teens is what they're expecting for DRAM and NAND. I kind of decided to make a little thing right here. Here's DRAM growth rate 15, that's mid-teens. NAND 28%, that's what they're saying right here. The current weights of their revenues for each of these industry groups is 72% and 25% by technology type, which, I mean, they have that right here. You can see this little bit right here. So if you just weight those together, that gets you a growth rate of 18%. The growth rate I've applied to them is 12%. So, you know, even this is the industry. It should be noted. This is an estimate of what the industry they say is going to grow at, not what the company's going to grow at. So it's like I'm saying my estimates are basically saying that the company is going to grow at about 2/3 of the overall growth rate of the industry. I think the CEO, Mr. Sanjay, I'm willing to bet he thinks he's going to grow at the industry. That's not the CEO. That's the CEO. So, you know, on one hand, you could argue that there's some huge growth that I've really baked into the assumptions here. But on the other hand, I think that 53.1 billion versus 30 billion, yes, that's like a 73% increase in revenue, but 73% increase in revenue for a 5-year period, looking at the overall cyclicality and elasticity of the revenue growth rate that they've experienced in the past, I definitely see that as viable. Now for the probability distribution, I have actually altered it a little bit for a lot of my evaluations recently. I haven't been altering the actual probabilities too much. I'm just kind of leaving it as more of a normal distribution. But for this one, I do actually have it leaned twice as much towards the more optimistic fourth model comparative to the second model. And that's partially because I do think it is far more likely that they get to this upside. And that is partially where this expected value comes from. That's already weighted at those probabilities. But I was just going to point that out now. So anyway, coming down to the profitability, that part's going to be pretty important as well. Now the profitability has been pretty extreme all over the place as well. As you can see right here, they've gone from anywhere from about 5% profit margin to a little bit under a 50% profit margin, though that was in 2018, and there is some kind of odd stuff going on in the numbers in that particular year. So, you know, their profitability is going to be a little bit all over the place. As we had said, for the last 6 years, on average, it's been about 30%, which is a pretty extreme figure to have in general. In the short term, their profitability is expected to pretty much go to absolute shit, which they kind of had already talked about. We talked about the overall guidance of the analysts. The analysts are guiding 53 cents for their EPS for the year in overall profitability, which is pretty extreme. I'm definitely not guiding that much low. I'm for my for the short term, I'm actually just guiding it to go to the 9-year average and then be cut in half, which gets me down to about $2.50 in EPS for the next year. So you could say that I am actually being a little bit more generous to them on the assumption that their EPS is going to be a little bit better in the short term, though this is also an adjusted EPS, and their EPS isn't going to be adjusted the same as mine. But in the long term, I do have this range of anywhere from 5% to 35%, which gets a midpoint of 20%, and then I'm leaning up towards 25%. Again, for the last 6 years, they had a profitability of about for the last 6 years, it's been 30%. So I am bringing down the profitability pretty significantly. And then, as we said, the probabilities are weighted a little bit more towards 27% than it is towards the 12%. So that is how we end up with an expected value of 23%. So I'm giving them very huge revenue growth rate, but I'm not giving them as great of profitability in the future. I am seeing their profitability come down. And then with that, I also have their sales capital ratio, which for the sales capital ratio, I actually am assuming that that part is going to go back up over time. You can kind of see that their sales capital ratio, as we had said, is a little bit lower in the last 3 years versus the 3 years prior to that. In those same 3 years is when they had the larger amounts of reinvestment going on in their business. So I do see this as basically being the low point of their sales capital ratio, and I see it being more likely that it's going to bounce back upward from here. So on an expected basis, we end up at 0.63 comparative to, like I said, they're currently at 5.4. So that's a pretty significant increase in the sales capital ratio over the 5-year period. And then debt to equity ratio, they have a pretty low debt to equity ratio to begin with. We're not really assuming that the debt to equity ratio is going to change that much. It's going to creep up by maybe a percentage point or two on an expected basis. That's me just being a little bit more conservative with that particular assumption, but that doesn't really affect value too much. And then all those assumptions together gets me returns on invested capital on an expected basis about 14 to 15%, which that compares in the most recent year with 16 to 17%. And then over the last 5 years, we saw 18 to 19%, which that kind of goes in line with, as I was saying, I'm making their profitability come down. So we would expect to see the returns on invested capital come down somewhat in line with that. And that's kind of what we get with those assumptions. So those are all the assumptions that goes into the valuation. And with that, we can come over to the final summary for the valuation. Before I get into that, I'll ask once more for anybody who's watching either now or on the replay, please give us a like. More likes helps attract more viewers to the stream, so it'd be very much appreciated if you could give me that. And also, if you're watching the stream, like it, and haven't already, please subscribe to the channel. That way you get notified when I go live or whenever I release any other content. Also, in the description below or the pinned comment in the chat is the link to the Discord. Join the Discord. We have a variety of channels discussing daily news, having discussions about what's going on in our portfolios, sharing funny memes about the market, looking at companies and analyzing various things related to that, or having other discussions and things like that. So come be part of the discussion there. We would love to have you there. Not to mention, it's a great place for you to give your recommendations for what companies you would like to see me value on the channel moving forward. So anyway, ticker MU, Micron Technologies, very interesting company, as I said. Happy to keep it in the watch list. As I said, we've covered it before, so really this is very much kind of updating it. 10-year treasury currently selling for about 4.1%. Mature market equity risk premium, as I currently have it, is 5.16%. It's pretty interesting to see that the equity risk premium is not that much higher than the actual risk-free rate at this point. The equity risk premium really has not increased as much as I would have expected it to relative to the increase in the 10-year treasury, which I would say means that the market isn't pricing in the risk of the interest rate as much as they should, but whatever, I digress. The discount rate that I come up with for Micron after adjusting for company-specific idiosyncratic risks is 10.89%. The current dividend yield is a little less than 1% on the current cash dividend. 5 years ago, they had sales of $20.3 billion. And in the most recent year that just ended, they have $30.7 billion, which equates to sales growth of 8.64% on a compounded basis for that 5-year period. So as you can see, kind of like, look at this. This is just one snapshot of one 5-year period that they looked at. And if you looked at it just in that isolation, you wouldn't have thought that Micron had grown that crazily, because they just happened to choose that particular year, where from this year to this year, which was a 5-year compounded period, it ended up being 86%, which makes it look like a typical company, right? You wouldn't have seen, like, you, based off of just looking at those 2 years, you don't really see the same extreme growths that we were looking at in the cyclicality discussion we were having before. So kind of just shows what I was talking about. It's like, if we don't know, maybe this year is basically in that same position where 5 years from now it's just going to be 8% growth, something like that. Whereas the company's saying that, oh, our industry is going to grow at 15 to 20%, or whatever. It's like, well, it depends on what part of the cycle you're in on that discussion. Anyway, I digress, getting distracted on that. Go back to the cyclicality discussion if you missed that. Sales capital ratio, the current sales capital ratio is 0.54. Again, that means that they get 54 cents in revenues for each dollar capital invested in the business. That compares to their industrial expectation. For the industry, we would expect it to be about 75 cents. The returns on invested capital they currently have is 18 to 19% for the last 5 years on average. And they currently have a debt to equity ratio of about 12 to 13%. The default risk they currently have is a little bit less than 1%, basically negligible amounts of default risk. And the profit margin that they had in the most recent 5 years on average has been 30%, compared to the profit margin for their industry of 19 to 20%. That is an R&D adjusted profit margin. Again, for industrial expectation, that's the semiconductor industry. They had profit in the most recent year of 9.4 to 9.5 billion, and they're currently selling for $54.86 per share. The probability distribution that we're using for the company, as I kind of mentioned earlier, is a little bit more tilted towards the fourth model. We put twice as much weight in the fourth model as we did in the second model, representing the fact that we are leaning definitely a little bit more towards these more positive outcomes. We just wanted to include some of the negative expectations, though we definitely believe that we're leaning more towards the scenarios in which these better expectations are likely to come out, specifically in regards to that cyclicality that we're talking about. Anyway, that gets us a revenue distribution of anywhere from 23.4 billion in the worst case scenario to possibly 93.3 billion in the best case scenario. On an expected basis, we see about 53.1 billion, and that equates to sales growth of anywhere from -5% to possibly 24 to 25%. On an expected basis, we see about 11 to 12%. Sales capital ratio on an expected basis, we see about 63 cents for every dollar of capital invested in the business, and the returns on invested capital on an expected basis end up about 14 to 15%. Debt to equity ratio we see at about 12%, so basically about the same as it was. And the default risk is pretty negligible, about zero. Like I said, really high cash flows and not a huge amount of debt. They can have basically no problem with their assets paying off their debts, especially given the cash flow scenarios we depict. In the profit margins, we have a distribution of anywhere from 5% to 35%. On an expected basis, we see about 23%. And that gets us a profit distribution of anywhere from 1.1 to 1.2 billion to anywhere to a high end of possibly 32.6 billion. On an expected basis, we see about 12.3 billion, and that gets us a present value after discounting across the various sets of outcomes with our assumptions of $56.09 per share, which is about 2% higher than the current share price. So they're basically about fair value. That we have 5-year forward value targets unadjusted for the dividends that they could choose to pay out during the period of anywhere from $8.13 per share to $335.05 per share. So a huge variability in the future outcomes, which has to do partially with our just wide range of profit margins. I'm perfectly aware that this is a pretty extreme range of profit margin distribution to apply to the company. But that's part of the reason I like to weight things and then come up with an expected distribution value to kind of look at everything. But anyway, the unexpected basis, we see $94.05 per share, which if you compare that to the current share price of $54.86 per share, that gets you an implied return of 11.38% per year for the next 5 years, which isn't really that great of a return. I mean, it's pretty good returns. It's fair value. It's fair value. You could buy it and it would be fair value, but it's like, considering all of the great operating metrics that we were talking about, like how great the balance sheet is, how great the management is, how great it's being run, how efficiently it's being operated. It has a great position in its industry. Its industry is in a general overall strong overall growth trend, as we were talking about. We're not certain of what part of the cycle we're in necessarily, but the overall longer term cycle is very much in place. So it's like it has a huge growth path in front of it over the long term. But the question really does come down to getting it at the right price. And the market knows that Micron's a great price, but it has come down in price. It was overpriced a bit more not terribly long ago. So it has come down pretty significantly, and its value has also probably come down because the interest rates have come up. Where did it peak at? I'm looking at it right now. Okay, yeah, just under $100 it got to under $100. I don't know what its fair value would have been considered under that interest rate if we worked backwards. But it's come down pretty significantly. So, you know, if you're willing to hold it at fair value, now might be the time. If you're looking for that margin of safety, well, you might need to wait a little bit longer. But it is a great company. This video, interesting company, getting it to the watch list. Yep, definitely going to be keeping an eye on it. Very, very high quality company. I'll definitely have to make sure I give it that high qualitative factor in the watch list myself. Actually, under 50 could be good. Under 50, maybe around 45 would be extra sweet. Something in that range. I don't know. Like I said, it all depends on what you see out of the model too. Another person might be much more willing to completely discount some of my worst case scenarios. You know, if you're feeling much more solidly about one of these slightly better scenarios, then it can look like an even better price right now. So that's what I was saying. It's like it all comes down to what you think about the future. 50 could be a good price. 45 would be an excellent price. You know, let me make sure I do actually tag it for quality before I forget, actually, because it didn't used to qualify for all the metrics that I consider a high quality company, because unfortunately one of the things that qualifies as a high quality company is having cash flow payout that is consistent and within range of your cash flows. And now they have their consistent dividend, and they've been more consistently paying out share buybacks. That puts them a little bit more in line with that. They did have good share buybacks before, but they weren't of good value before, so they weren't a good company for that reason alone. But now I want to make sure where are they? MU, there they are. Green. Tag this one green before I forget. Okay, yeah, so that's going to do it for the stream today. I am taking a look at a few other companies for what's going to be doing for next week's valuation. Apple is one particular company that just released their 10K. So that's definitely one that's very much I'm going to be doing it one way or the other at some point in the near future. There's other companies that have their 10Ks coming out basically this week, and it really just kind of depends on which ones come out first. I might put up a poll or something to see which companies want to do, but I'm going to be taking a look at Qualcomm whenever it releases its 10K, Skyworks when it releases its 10K. Like I said, I've already started taking a look at Apple. I'm going to probably be taking a look at DR Horton Homes. That's another one that we've covered before that I'm probably going to be taking a look at in the near future. And then there's other ones that I'm considering looking at in the near future that I've looked at before that I may or may not decide to keep. I haven't decided in the watch list, which is HP and Sally Beauty. So there's other companies that are on my mind for the future. Like I said, almost certainly Apple's going to be coming in the very near future, but if other companies release their 10Ks literally in the next couple days, then I might put up a poll or something to see what other people want. If you want to suggest other companies for me to look, you can always throw them in the comments, throw them in the chat, come and join the Discord and suggest them there. All right, I'll catch you all again next time. Bye.